A. Explanation of what it means to go public. Going public refers to the process of offering shares of a private company to the public for the first time, typically through an initial public offering, IPO. This is a significant milestone for any company, as it provides the opportunity to raise significant amounts of capital and access a broader investor base. When a company goes public, it becomes a public company, and its shares are available for purchase by the general public through stock exchanges like the New York Stock Exchange, NYSE, or NASDAQ. This means that anyone can buy and sell shares in the company, and the company's financial information becomes publicly available. B. Brief overview of the pros and cons of going public. Going public has several advantages and disadvantages, and it is crucial for a company to carefully consider them before making the decision to go public. The pros of going public include increased access to capital, increased prestige and visibility, and potential for growth. On the other hand, the cons of going public include increased regulatory scrutiny, loss of control, and short-term focus. In the following sections, we will explore each of these pros and cons in greater detail, as well as examine some case studies of companies that have gone public and either thrived or struggled. Ultimately, companies must weigh the potential benefits and drawbacks of going public and determine whether it is the right decision for their unique situation. Pros of going public. A. Increased access to capital. 1. Ability to raise significant funds through stock offerings. One of the most significant advantages of going public is the ability to raise a significant amount of funds through the sale of shares to public investors. This provides companies with access to a large pool of capital that can be used for expansion, research and development, and other strategic initiatives. Additionally, public companies can issue additional shares to raise additional capital in the future, providing ongoing access to funds as needed. 1. Greater liquidity for shareholders. Another advantage of going public is that it provides shareholders with greater liquidity. Publicly traded shares can be bought and sold on stock exchanges, providing investors with the ability to sell their shares at any time, unlike private companies where shares are typically held for longer periods. B. Increased prestige and visibility. 1. Going public can enhance a company's reputation. Going public can enhance a company's reputation and lend credibility to its operations. Publicly traded companies are subject to greater scrutiny from investors, analysts, and the media, which can serve as an endorsement of the company's viability and success. 1. Public companies are more visible and often have a higher profile. Public companies are more visible and often have a higher profile than private companies. They are subject to greater media attention and may be included in stock market indices, increasing their visibility and raising their profile among potential customers, partners, and investors. C. Potential for growth. 1. Access to public markets can help fuel growth and expansion. Going public can help fuel growth and expansion by providing companies with access to public markets, where they can raise additional capital to fund new initiatives and strategic investments. This can be particularly beneficial for companies in industries that require significant capital investment to grow and scale. 1. Greater access to financing can lead to increased innovation. Public companies have greater access to financing than private companies, which can enable them to pursue new innovations and technologies. This can give public companies a competitive advantage over their private peers, as they have greater resources to invest in research and development and other strategic initiatives. Overall, the advantages of going public are significant and can be a game changer for companies looking to raise capital, increase their visibility, and fuel growth and innovation. However, there are also significant drawbacks to consider, which we will explore in the next section. Cons of going public. A. Increased regulatory scrutiny. 1. Public companies must comply with more regulations and reporting requirements. Going public comes with a significant increase in regulatory scrutiny, as public companies must comply with a variety of regulations and reporting requirements set forth by the Securities and Exchange Commission, SEC, and other regulatory bodies. These regulations can be complex and time-consuming to navigate, and failure to comply can result in significant fines and penalties. 1. Increased risk of litigation and reputational damage. Public companies are also subject to increased risk of litigation and reputational damage. Shareholders and other stakeholders may initiate lawsuits or investigations if they feel that the company has acted improperly or violated regulations, which can be costly and damaging to the company's reputation. B. Loss of control. 1. Going public often means giving up a degree of control to shareholders. When a company goes public, it typically sells a portion of its ownership to public investors, which means that the company's founders and executives must share control with a broader group of shareholders. This can result in a loss of control over the company's strategic direction and decision-making. 1. Shareholders may have competing interests and priorities. Public companies must answer to their shareholders, who may have competing interests and priorities. Shareholders may pressure the company to focus on short-term gains rather than long-term growth, which can result in decision-making that is not in the company's best interest over the long term. C. Short-term focus. 1. Public companies may prioritize short-term gains over long-term growth. Public companies are often under pressure to deliver strong financial results in the short term, which can result in decision-making that prioritizes short-term gains over long-term growth. This can be particularly challenging for companies that require significant investments to fuel innovation and growth, as short-term thinking can result in underinvestment in the company's future. 1. Pressure to meet quarterly earnings expectations can lead to short-sighted decision-making. Public companies are expected to meet quarterly earnings expectations set by analysts and investors, which can result in decision-making that prioritizes meeting these expectations over long-term growth and innovation. This can result in a focus on cost-cutting, reducing research and development spending, and other actions that may improve short-term earnings but can harm the company's long-term prospects. Overall, the cons of going public are significant and should be carefully considered by companies before deciding to pursue an IPO. The loss of control and short-term focus can be particularly challenging for companies that prioritize innovation and long-term growth, while increased regulatory scrutiny and litigation risk can be costly and time-consuming to manage. Case studies. A. Examples of companies that have gone public and thrived. 1. Facebook. Facebook went public in 2012 with a record-breaking IPO that raised $16 billion, and the company has since grown into one of the world's most valuable and influential technology companies. While Facebook has faced its share of controversies and challenges over the years, the company's stock has consistently performed well and the company has continued to innovate and expand into new markets and business lines. 1. Alibaba. Chinese e-commerce giant Alibaba went public in 2014 with an IPO that raised $25 billion, and the company has since become one of the world's largest and most successful e-commerce companies. Alibaba has diversified its business lines to include cloud computing, digital media, and entertainment, and the company has continued to grow rapidly despite increasing competition from domestic and international rivals. B. Examples of companies that have struggled after going public. 1. Snap Inc. Snap Inc., the parent company of popular social media platform Snapchat, went public in 2017 with a highly anticipated IPO that valued the company at $28 billion. However, since going public, Snap has struggled to grow its user base and has faced increasing competition from rivals like Instagram and TikTok. The company's stock has underperformed since its IPO, and many investors have expressed skepticism about the company's long-term prospects. 1. Blue Apron. Meal kit delivery company Blue Apron went public in 2017 with an IPO that valued the company at $2 billion. However, since going public, Blue Apron has faced increasing competition from rivals like HelloFresh and struggled to retain customers and grow its business. The company's stock has fallen significantly since its IPO, and the company has undergone significant restructuring and cost-cutting measures in an effort to turn around its fortunes. These case studies demonstrate the potential rewards and risks of going public, and highlight the importance of careful planning and execution in order to succeed in the public markets. While companies like Facebook and Alibaba have thrived since going public, others like Snap Inc. and Blue Apron have struggled to meet investor expectations and compete in increasingly crowded and competitive markets. A. Recap of the pros and cons of going public. In this video, we explored the pros and cons of going public. On the one hand, going public can provide increased access to capital, greater prestige and visibility, and potential for growth. On the other hand, going public can also come with increased regulatory scrutiny, loss of control, and pressure to prioritize short-term gains over long-term growth. B. Consideration of whether going public is right for every company. It's important to note that going public is not the right choice for every company. The decision to go public should be based on a company's specific goals, financial situation, and long-term strategy. Some companies may be better suited to remaining private or exploring alternative financing options, while others may benefit from going public. C. Final thoughts on the decision to go public. Ultimately, the decision to go public is a complex and important one that requires careful consideration and planning. While going public can provide significant benefits, it also comes with significant risks and challenges. Companies considering going public should weigh the potential benefits and risks, consult with experienced advisors, and develop a clear and comprehensive plan for managing the transition to the public markets.